All right. So, yeah, guys, welcome to the Stock Market Technical Analysis by Jitin. I'm Nimish. Jitin is sharing this PowerPoint. And the goal here is to learn what traders do, what tools they use, what charts and graphs they use. So, we have fundamental analysis and technical analysis. Technical is mainly used for short term trading, day trading, and basically not a long term. So it's purely math based and price and volume based. So I'll hand it over to Jatin. Jatin has done good research. He has a good background also in finance. So here we go, Jatin. Let's get started.
All right, thanks, Nimish bhai. Hi, everyone, once again. So, quickly jumping into what essentially we'll cover today is understanding the basic differences between fundamental and technical analysis. And fundamental is mostly driven by the news that we are looking at, the macroeconomic indicators that we see, and what is driving that particular asset. And why I say asset is it could be a stock, it could be a commodity, it could be an economy, anything, it could be real estate. So what are the drivers or key factors that affect that particular asset is what is included in fundamental analysis. On the technical side, however, as Nimish mentioned, it's more about price action. So what are we seeing at that point in time live on the trading floor, or right now it's all electronic, so we call it the tape, or some people call it the ladder. But it's essentially every price which is being traded at every moment. Why I'm saying every moment is because in the high frequency world, it moves in microseconds, literally nanoseconds. So that's the level of volume that we look at, especially in very high liquid products such as crude oil, or even index. All the index futures, especially S&P, etc., are very high volume products. So you'll see trading happening in like micro nanoseconds. All right, then we'll look at what I like to call the Batman's belt. I don't know how many of you watched, but I watched a lot of Batman comics and cartoons when I was a kid. And in Batman's belt, he used to have all kinds of things. The hook that can take you up, the smoke bombs. It also used to have a medical kit, something like that. So TA is essentially one of those pockets within the belt where you look at multiple things, but you need to be aware of what is there on the technical front, because a lot of RPMs or portfolio managers or traders of the world, they will always have some input from their technical guys telling them this is a level, this is another level, and that's what drives their day to day or in the point decisions. Then we'll see what are some limitations of technical analysis. It's not, there's no holy grail, there's not something that will always work. There are things that each individual or each trader or each investor would like to personalize. I'll show some of the charts and analysis that I follow. I personally and there is tons of these analytics and indicators, right, that you can follow. So statistics is basically which drives all of these indicators, and individuals that develop them over a period, most of them mathematicians who kind of took historical data and created a theory, and then that theory further developed into a actual formula, and that formula is now applied on top of the data to come up with a analytic chart. So it's called an indicator. We apply those indicators to see, what, or try and predict what the market would look like in the future. So there are other basic elements which we'll go through, but consider this not even as a 101 class. Consider this as I would say, a preface to the whole introduction. So it's a vast ocean of knowledge between technical analysis, chapter 1 and chapter, I don't know, infinity. Everyone would keep on continue to play around with different analysis, different time periods, different, I would say, ways of looking at the same chart, because the same information is available to the entire world. And why I say the same, because it all works on historical information, and based on certain patterns, certain trends or ways the price has moved, everyone would try and infer the next move. No one has a sure shot answer. There is no certainty in the entire analysis. However, most of the times people do follow these because there are certain, let's say, call it certain high probability patterns that form, and after which a lot of people would take a position based on that. So that is a quick introduction of what TA would have as a limitation and a benefit, but we'll see further on the slides, where we should apply them and where not. And then I'll give a demo of, how I access my charts and what analysis I look at. So moving on, a quick Investopedia definition of what is TA, technical analysis. It's a method of analyzing and predicting stock movements based on past market data, as I said, and it collects, or any charting software all across the world would have the tick level data. And tick level is what I initially mentioned. The markets are trading every second, even nanoseconds, when they are open, and that each price trade is captured by our high-end softwares, which will then try and store that data, and the charting software goes into that data, picks up every price and what was the volume traded on that price, and then map it into a chart. And we'll see how that populates in some of the charting analysis that we do. What's fundamental analysis? So in comparison, fundamental is, as we discussed, what is the real asset driving factor? So what is the real or intrinsic value of that particular product or asset that we are looking at? So for example, a stock's fundamental analysis would include everything that is happening within the company, outside of the company with its competitors, and then let's say the results that come in every quarter, the annual results, etc. But it is also sometimes impacted by an economic crash, for example. The scenario in which that company or that particular industry is also part of the fundamental analysis of that particular asset or company. Similarly, when you talk about an index, now index is a pool of stocks, or a bunch of stocks that are combined together based on a certain hypothesis. And why I call that hypothesis is because every index has a certain formula based on which companies will come into the index or go out of the index. If so far as they meet that criteria, that formula, they will be part of that index. As soon as their matrix change, their results change, and they no more meet that criteria, they'll be taken out. So that index or that bunch of companies together is the basis of that particular asset. And that's how the entire value of that index would change or move every second or every day. So having said that, we'll look at, what are the starking differences. When we talk about fundamental analysis, the method or as I said, the formula that we use to calculate that particular asset or that particular stock is different. When we talk about an individual stock, it could be using a DCF or a discounted cash flow method. When we talk about a bunch of companies in the same industry, we could use a comparable comp set analysis, which will look at all the values of all those companies which are competitors, and then their individual, let's say, EPS, their EBITDAs, or financial matrix through which we compare all of them. And that's a relative measure of comparison, but it's still a very fundamental analysis. Similarly, when we come to indices, or when we talk about, let's say, real estate, all of these are assets. And these assets are, again, if you buy a house, you'll receive a report from the bank or the lender telling you about 5 or 7 or 10 houses that were sold in the same area in the past 1 year, and their values, their number of rooms and number of bathrooms, right? So all of that is a benchmarking exercise which drives the fundamental value of that particular asset. On the other end, the technical analysis is basically the price movement for, or the, let's call it demand and supply of that particular asset in that particular point in time. It does not account for how that asset is valued, or why that asset should be at the price that we are looking at. It mostly works on a very live scenario where there are more buyers, so the price will go on rising. There are more sellers, it will keep on falling down. It does account for fundamentals, but that fundamental analysis is done before we see the technical analysis impact. So technical is always live in the moment. Fundamental is more, what it should be. So moving on, some of the KPIs for both of these, what is the definition, and I think we'll share the deck, but I can go through all of these. I don't want to spend a lot of time reading out stuff on the screen. But if everyone is comfortable, we could just move on to demo. So this was the Batman's belt, and I wanted to share some of the tools that traders use on a day-to-day basis, and what kind of let's say information access do they have, which gives them an edge over retail investors like us. At the same time, that profession or that day job that they do relies on different pieces of information, or what to use when is very key in the entire profession. So they have access to charting softwares. They have access to, and the most high end, there are professional softwares that people use, which they pay probably hundreds of dollars a month just as a subscription to use that software, because one, it will have access to the tick level data for a lot of products all across the world. Then it will have almost every indicator that you can apply on that particular data set. And we'll see, how that indicator list and those analysis populate in different softwares. Then they have access to news. So, Reuters news, for example, is one news flash. And all of these, again, are very subscription-based models. There's Squawk Box. Squawk Box is what we see on TV as well, but this guy, he talks as a commercial show. These Squawk Boxes are, call it a person sitting next to you, shouting in your ear, really live during the market hours, what is happening where in every market possible. So, they are again subscription-based. Again, thousands of dollars go into news sources as well on the trading floors and where actual traders are doing their trading. Then price action and ladder or tape, as I said, what we call is the software that they use to actually trade. So when we trade, generally, if you're using Fidelity, Vanguard, or even an individual broker, unless you're using their actual desktop software, you'll see, you'll probably end up using a web interface or a mobile app through which you put your price, you put the number of shares or whatever units you want to buy or sell, and you enter the trade, and that's it. The software over here is much more advanced. We are talking about the softwares which provide algorithmic trading, cost approximately $2,200 a month. So you're talking about just one license. So you're talking about that software in itself, which gives you depth of the entire market. So you can actually, let's say the price is trading at 4110, which is the S&P price as of yesterday. If the market is trading at 4110 and you want to look at, let's say 3900, and how many buyers and sellers are standing at that price, you can actually do that in those software. So it's that advanced. You can move 100 points away from the current market and look at how many buyers and how many sellers are standing at that price or waiting at that price. Similarly, they have access to information which we would never get. For example, they'll know open interest at that particular point or day, at the close of the day, at the start of the day, which affects a lot of their decisions during the day. They will have access to option information, which we probably could, but even if we did have access to it, unless you're a very advanced trader, you'll not be able to make sense out of it, that the gamma thetas of the world. So all of this really helps the traders or the portfolio managers basically manage their job during the day, and this information is really which gives them or gives them an edge over and above all of the retail investors such as us. So they also abide by like their rules and their stop losses and whatever they've planned for the day before the day or the market starts. They actually abide by it, and that discipline is what differentiates a good trader from a bad one, or a rogue trader. They never trust hearsay. So anything that is, oh, he was telling me this will go up or that will go down, no one looks at it or even pays any heed to it. It's mostly all your charts, all your data analysis, everything that you decide that you want to do with that trade, for whatever product you are trading. And again, that flows into the next point, which is knowing your product and doing your diligence. So they'll have, before the market opens, some products trade 24/7. They just close 1 hour during the day, in the night when the exchange basically reconciles all the pricing. But other than that, they'll trade like gold. It trades 23 hours a day. It just closes on Saturdays, and Sundays 6 p.m. it'll open again with Tokyo Open. So when I talk about knowing your product, it's a lot of factors that go into it. So for example, how liquid is the product? Would you see a large price differential between the bid and the ask price? There could be some products which trade very slow. They might have a large volume. So for example, STIRs, short-term interest rates. So short-term interest rates trade at very large volumes. At each tick, there is a trade of about 25,000 to 50,000 units traded at each tick, and each tick is 25 cents, maybe less. So you can imagine that, because banks are trading and their volume is just simply huge, the entire day's movement could just be 4 ticks, sometimes not even that. So you can imagine that, that product could be really dull to be sitting in, but it's all about volume, hedging, etc. So it depends, what are you trying to trade and why you want to trade that product, and do you understand the liquidity and other dynamics of that product. One guru mantra that we were taught, and all of us used to follow, and I guess all the professional traders do, is to know when to get out. It's not about getting in. You can jump anywhere, anytime, buy, sell, whichever position, long, short, but it's all about knowing when to get out. So 90% of the traders fail in getting out at the right time. Even if it's making a loss or booking a profit, you will end up making your maximum losses in a trade where you did not get out at the right time. You were given all the information before this, your charting signals, your indicators, everything was telling you to get out at that price. Just that particular trade or that human emotion, and which we'll talk about, is something that, caused a huge loss. Instead of something which could have been booked at 10% loss, you ended up paying 50% for. So it is very, very important when to know, when to get out. There was another example Nimish Bhai and I were discussing yesterday, where one gentleman, just before he panicked, looking at a recession, and he kind of booked his loss. The market went down. He did not buy it when it was down, assuming that it'll go further. It jumped back to the break-even point, and then he bought at a price higher than where he actually got out. So eventually losing a couple of percentage points. But it's all about doing your diligence and knowing what you entered into the trade for. If it's a long-term horizon, do not play short-term. If you're looking at a short-term horizon, make sure that you exit your position, be it a profit or a loss, within that time stipulated for which you gauged or you analyzed the market. So if you're talking about, oh, I am a long-term investor, I invest for 5-10 years, the next recession that comes in the next 2 quarters or 1 year, you should not be thinking about selling. Do not think about making a short-term profit. Oh, I'll just sell here. It is definitely going down. I'll buy again and I'll make a profit. If you're doing that, you're kind of breaking your discipline, and somewhere down the line that might cost you quite a lot. So stick to your philosophy, stick to your principle of why you entered the trade, what was the original horizon, and should you be, taking a decision based on that particular theory. All right. And lastly, no single technical analysis, chart, tool, whether it's time period, whether it's the indicators that we apply on top of the chart, work all the time. And they would keep on changing because, as I said, it's all historical, based on historical data. All the professionals of the world have access to much better data than us. So they are looking at the same charts, they are looking at the same data. They know, what this particular indicator is, what it means, and what people will now take a position as. So if a particular indicator says that from here it should be a reversal to long to buy, they all know it. So they will make sure that it breaks down the level. Everyone thinks now it's a sell. They go sell and they buy it from there. So it's always like that somehow, and that's why we say the market knows it all. The market prices it, as we call it. All of that is because the big hedge funds or the big firms and the big trading houses, they know this information much better than us and they play around with it. So for us as retail investors is something we look at, what should be the right approach to, I think, combining fundamental as well as technical analysis. So knowing what tool works when is more important than knowing how to use that particular tool itself. All right. So again, what is the market, or I would say the addressable audience for TA? What's the addressable audience for fundamental analysis? So traders, short-term, trading, and then using charts and price action is what comprises of technical analysis. On the fundamental side, it is more long-term in nature. It's investing and then sitting and baking it. It's used by retail investors mostly. It's also something is adopted by certain firms which have that fundamental approach, but it's also something that we kind of promote for anyone who's not an active investor. So if you think you have a risk-taking appetite, and you can probably understand most of the things on the left, it is still advisable to not do it with the entire portfolio. So if you have $100,000 portfolio, make sure you're allocating about 10 to 20% of that portfolio into the left side, which is the technical side, because it involves a lot of active, it will take your time, it will take your mind space, and it'll play around with your emotions quite a bit. So unless you are ready to pay that cost, I would advise strongly to stick with the right side and make sure that we kind of develop and adopt certain things from the left side, which might help us refine our fundamental analysis approach as well as methodology. So looking at some benefits of technical analysis where it might help retail investors is, so knowing what it is definitely an advantage because it tells us certain levels. It tells us what kind of patterns should we be looking at, and if a pattern breaks, then what happens. Sometimes it could be a false indicator. Sometimes it's like so for example, for me personally, and I'll show you on one of the charts, the policy that I adopt in doing my investing as well, which is my right side, is I look at levels on the chart. And then I never do stocks, just a disclaimer. I always do indices or ETFs. But for me, there's a level that I'll identify, and then I'll put a trade on that particular level. Even if the price goes down further, it's okay because I wanted to create a long position. I saw a good level. And sometimes it happens, the market comes just before that level and it'll go back up. So I don't even get that trade, which is the fear of losing out, right? So for me, it is more about sticking to my discipline. I identify the level. It goes down further. I don't care. It goes just a few ticks before my price. I don't care because I'm not monitoring it actively. As soon as I start doing that, I'll be emotional with my trade. I will make sure that, oh, it's so near. Let me buy over there. I'll end up paying a few ticks more, a few, dollars more on the price. But eventually, the market might go down further. So I'm not controlling anything in the future. all by doing and watching it all the time is I'm playing with my mind. I'm trying to include my psychology into it and trying to anticipate something which I have no control over. So, those levels, as I mentioned, is something that I use TA for. And once I know a level, I just put my order and forget about it. Whenever it fills up, it fills up. I don't care. Similarly, monitoring my charts keeps me active in terms of understanding how the market is moving. Sometimes it will be slow, sometimes it'll be rapid, and all of those help certain of my decisions. Not every day, and not I don't even trade every day now, but it helps me understand. So, for example, if the market falls 3% in one particular day, it will be some indication to me, and that I can only know by looking at the chart for the previous day, how it moved, whether it was a 15-minute move or whether it was a 30-minute move, or whether it went slowly down over 5 hours, is something that tells me something about that market. So, that is where my TA comes in handy to me. Over a period, with some experience, once you start looking at these charts on a regular basis, you'll develop your own indicators, as I said, your own style and your own statistic analysis to put on top of the chart to understand, what might happen. It'll still be just an understanding. As I said, there's no sure shot. Even the highest level CMTs definitely go wrong, but their accuracy is much higher than us. So, they'll still be able to do it professionally. They have degrees. The degree is called a CMT, a Chief Market Technical Analyst, which is, which gives them the edge, and they probably could predict it with much more accuracy, and their tools are, of course, much more advanced. And then for me, TA is it's therapeutic. It's kind of helps me soothe whatever movement has been, has been. It's all historic. But for me to look at different variations in the chart, to look at those patterns, it just makes me feel nice about, I'm using my brain, doing something with my money, which is passive, but I'm still looking at things. So, and I've been, part of that life. So it probably keeps me in touch with that aspect of me. All right. So, what is essentially a pattern, or when we look at a chart, it could be a line chart, it could be an area shaded chart, but I like to stick with candlesticks, and I'll show you what that is. But for me, it's more around, how the market has moved and what kind of a pattern is it creating on the long-term horizon. I do not generally look at, when I used to day trade, I used to have a 1-minute chart, a 5-minute chart, a 30-minute chart, and then a 2 or 4 hour chart at the max. Today, I'm talking about a daily chart and a weekly chart, sometimes even monthly. So, I'm because my whole horizon, my whole theory around investing has changed. So when I'm talking about long term, I also look at long term charts. So it totally depends on what are you trying to do with that particular trade. If you want to go into a trade, you probably have some news from somewhere and you want to enter into a trade for a week. Do not look for a daily or a weekly chart. That is something that would not tell you the right story. You're not looking at the right picture. You will end up making a loss most likely, because you'll not have the right price movement for that product. You'll not be able to capture the right level. Whatever levels you're looking at are daily and weekly, which define like a 3-month period. Not, if you're entering for a week, you need to look at max a 2-hour chart, I would say, or probably, because look at it that way. The product, once you know it trades for 8 hours a day or whether it trades for 23 hours a day, you know how many cycles it will make. And that is what you need to track. So, as I said, the pattern will define the entry and exit. So your objective of the trade, what's the duration of the trade, what's the time you want to stay in the market for, all of that would define your entry and exit and your levels. Also, sometimes, these patterns are as I said, the market is looking at much more of this information with much more in-depth analysis. So they'll know all these levels. And that's where they play the psychological game. They'll make sure that the level which is showing a buy is what they want to break, because that's where they'll start eating all the stop losses of the folks that have that buy level trade, and then they put their stop losses under that price, and they'll know where to eat those stop losses because they have that information. So that's why, doing a day trading job gets much more difficult with the level of, trading that you're doing. So level as in, how much is your total portfolio managed? How much is the fund that you're looking at? What kind of analysis and tools do you have? And what's the access of the brokerage that you're working with? So by access of brokerage, I mean, when you're talking about high frequency trading, you want to have an algorithm which runs on the exchange itself. You cannot be doing it from your home. You cannot have it on a normal internet line. You would not succeed because all the major brokerage houses will have their own stations at the exchanges of the world, and they'll have the information much before you do. And I'm talking about, again, from an exchange to a brokerage might be nanoseconds, but till the time that information comes to you as a retail investor on your home screen in the house, it's probably 10 seconds of it. And I'm not even kidding. Like 10 seconds is major for all of these price movements. So definitely day trading at home is a big no-no. All right. As I said, what time horizon you're looking at, what fractal in the chart you're looking at, it depends on the original trading strategy or the trade that you wanted to enter into. So whether you want to look at a minute, daily, weekly, etc., is something that is defined before you enter the trade based on the objective of the trade. Some human tendencies, and the biggest one which I would like to highlight is emotion. As I said, as soon as you start doing active trading, the biggest I would say detriment to your profit would be your emotions. And that works both ways, even making or booking a loss and taking a profit. The greed, the fear, whatever you might want to call it, it will play a role, and you would not even realize. It's, gambling is an addiction, they say. The addiction is not with the money you win and lose. The addiction is the adrenaline rush, the tendency to, oh, next time I'll definitely win. And even if you won, I'll win more, or, something or the other. So emotion being the biggest, everything else follows. So, once you are emotional about a trade or your own money, and that's another caveat I like to highlight is, when you're doing active trading, I would advise never do it with your own money. It will be the highest emotional aspect you'll probably face. When you're trading on others' money, it's as simple as this. It's at least not that emotional for you. Your bonus and your other things might be dependent on it, but it's still a bit of disconnect. When it's your own, every dollar, every rupee, every unit counts. So you'll start seeing patterns even if they are not there. You want to look at a pattern based on your position. So if you're long, you'll try to see or skew the charts in a manner, because it's all historical. You can interpret it the way you want. You'll want to look at the chart where it shows long. Oh, yeah, I was correct. So you'll try and, make sure that your own opinion is what is being reflected from the chart or the pattern, whether it's true or not. Similarly, as I said, market noise. Again, you will hear about a lot of news on the asset that you're trading. You will hear about, other traders commenting on it based on their position on that particular stock or asset or index. But it will impact your decision to a point, to a certain extent. So to distinct yourself from that, you would need to rely on your TA. If you do not, what happens is you're mixing two aspects which are very distinct. One might be based on something, the other might not. So when you're talking about technical, it still has the historical information of data which you're relying on. But if you're talking about fundamental, or you're talking about an opinion, you don't know the basis for that. The fundamental guy might have his or her own beliefs and logic to it. The person who's blabbering again might have something, but you don't know it, right? So as a trader or as the owner of the trade, you cannot mix those things. That will be detrimental. Again, all the TA, it looks backwards. It's never forward looking. The data is just not there. So anything in the future is what you are assuming. It's all something that you want to happen. It might not. Whatever trade you decide, you identify the pattern, you get into a trade, you set a stop loss, you set a take profit, then stick to it. Sometimes what happens is we are sticking to it for too long, assuming it'll come, whatever it is. And it does not happen. And the conditions have changed and the market has changed. There's some news breakout, there's something that happened, and we were not privy to it. That again, unless we are very, very actively sitting and doing this 24/7, we are not aware of that news that is happening every second of the day. And it will eventually end up causing us to have less or partial information, which can be detrimental again. So, TA has its own these set of negative aspects, which I think come over a period. All right, so some do's and don'ts. I would advise anyone who's new to this to at least do 30 days or trading days, which is almost 1.5 months of looking at the chart, trying to identify the pattern, trying to identify your trade, and then putting it on paper. So, which is the next point, is maintain a general, enter your stop loss, enter your entry point, exit point, your take profit, and the time interval. So if you look at a 30-minute chart and you decide, yeah, I'll take a position this morning, I'll exit it by end of or before end of the day, stick to it. Even if the prices did not hit, your take profit or your stop loss, you have to cut your position at the end of the day. It's all on paper. Do it. It'll help you refine your strategy. And as I said, all of these keep on changing on a daily basis. What will happen is, if a 30-minute chart on a particular index was working yesterday, it might not be today. Today, it's very volatile. It's working on a 5-minute chart. Tomorrow, it's very slow. It might be looking at a one-day chart. And all of this is very in the moment. It's happening all the time. So that's why you might have seen, in some movies or some places where if you go to a trading floor, every desk or every trader is looking at 8 to 10 screens. And why those 8 to 10 screens is because there'll be one screen showing a 1-minute chart of 5 different products. There's another screen showing 5-minute charts. And, a lot of that information, what we just looked at, is that they want to capture every time. So before entering a trade, 1 or 2 screens would have just the ladders or just the trading platform, prices to enter and exit out of. So all of this is needed for that person to be successful, for that trader to be successful. Know the charts, and they are historical and not future predictive models. So, over reliance could be something that might be impacting you. But if you know it, it helps. So you need to know and kind of inculcate it within you every moment that you are on the screen or trading, trying to do it actively, that this is something which is not going to tell me the right picture. Keep on hitting yourself in the back and know that. But if you're doing a investing exercise using this, it just helps you because you're not looking at it every day or every hour of the day. Things that you do not or should not do. One, again, assume the pattern that you've recognized is unique to you. It's never. Do not break your discipline. Don't trade during market noise. And what I call market noise is, a lot of times the market would just keep on moving like this. So you were looking at a 5-minute chart, first 5 minutes, second 5 minute, third 5 minute. The day might end just like that. And it causes you desperation to enter or exit at some point, because you were looking at a 5-minute chart. You thought it should work like that. It should go now. Now it will go. Now it will go. Now it will go. It did not go. Simple. And don't day trade. It's just not your job. I mean, you being paid or you earn money through something else, I'm assuming. So far as that is the case, do not attempt to day trade. And that's a big don't. So, we want people to be successful here through knowing what it is, but at the same time adopting the best of the best that is possible. All right. So, I'll now take you through some of the charts that I look at and what do I set it up as for myself. Um, so I go to this site. Can you still see my screen, all of you? Anyone can confirm that?
Yeah, we can see.
We
Okay.
can.
Okay. So I generally go to investing.com and I'll take you from the top again, from the home page. When I go into investing.com, it gives me all that information, but let's look at US 500 or S&P 500. Once you click onto any product, it'll land you onto the basic overview page, and which will populate a chart of that product. It'll give you some basic information and then news about it. Right. This is the template or the flow of the document, the site. Now, I would look at, sometimes when I don't have much time, I will not go into a technical chart. I will just look at this, look at it in the candlestick pattern, as I mentioned. For me, this is much more useful than the line chart, and I'll tell you why. So the line chart is taking the top tips of all of these candles, and it's making a line like that. It'll go to the top tips, and it'll make a line like that. It does not tell you how much variation during that. This is a 1 day that we are set up at. How much variation during the day was there? The green candles are all the days that closed in positive in the green, and the red ones are what closed in negative. And there's basic understanding of these. The top point on a red candle is where the day started. The bottom point on a red candle is where the day ended, the close price, and you can see it over here in this small gray box, the open price, the high, the low, and the close. The volume they don't provide in this software, but some brokerage softwares would provide you that. And the tips of the candle, why they are called candles is, so the tips of the candle, this tip is the high point. Similarly, a tip below the candle would be the low point, but this is where it opened and closed. Similarly, in reverse for the green candles, this is the bottom point of the day. This is the highest point of the day. The market opened over here and the market closed over here. So it made a green candle. That's the basic understanding. So let's get into a technical chart, what we look at. And they keep on organizing this. I think some brokerages also do that. So you could look at your particular brokerage and see if there are some sessions that might be useful if you're really interested to kind of develop this. But I was doing some search yesterday, and this would be a good document for you to look at. This gives all the basics of technical analysis by Fidelity. So it's on the Fidelity website. And a lot of us have Fidelity anyways, but I'll put it in the group. Nishwai, you can also put it on the drive, the OneDrive. People can have access to it, but it's a good, useful document. So this guy, who's the author, he's a CMT. As I said, they are specialists and they have their education degrees in this. So when he probably did a chartered market, whatever technician course, he got employed by a brokerage or a big firm first, and then ended up during his retirement age in Fidelity, now giving mostly advisory work or doing
Can you copy this link and post in the chat?
I'll send the link, in fact.
Okay.
Should I just send it to you personally for now, Nimishbhai, and then you can
yeah, chat mein dal do. Yeah, Zoom ke chat.
okay.
Or it doesn't matter. You can do that. Yeah, that's fine.
All right. So this would be helpful just to understand the basics, but let's get quickly into it, because unless we are doing this as a day job, we don't need all that technical analysis, to be honest. We don't need it to be very, very in-depth. It will, as I said, it'll take a lot of mind space. It'll, the results are just not worth it. So I set it up to be on candlestick pattern. These are my candles. I then look at a horizon. For me, the longer, as I said, I look at a daily or a weekly chart. So I can change my time from here. I can look at a 1 minute chart, 5 minute, but in real, like professionally paid softwares, you'll even have tick level. There's something called a tick. Tick means every price it traded, every price during the day or during, that trading session. So I look at a day or a week chart. Sometimes I do five hours, but every time I change the horizon, the chart will look different, although it's the same set of information, right? Nothing is changing. It just takes some markers over here. This will be a 5-hour window. This will be a 5-hour window. So every candle will become a 5-hour window. That's all that's happening. So let's stick to our day chart. And when we do this, now can someone tell me how to move this or just move it out because I need to work with my charts. Okay.
We can see the chart.
No, you can see the chart. I'm looking at that bar also, which I can't hide. I don't know how. But
Oh, the zoom bar.
the zoom bar, yeah.
There's
You,
3 dots on the right.
yeah, and then it
And
says
there's
more
a
and then
hider.
hide video panel. Okay,
Huh.
hide video panel. It's still there. I don't know. Hide floating meeting controls. Okay, got it. Yeah. So, this, for example, right now is showing us data from March 2015 or 16, all through today, right? This is the last. Now, I would set this up based on whatever view I'm trying to make. And my view right now would be to look at a long-term horizon and a long-term strategy to invest in the S&P, for example. So I'll then start applying certain patterns on this and certain analysis. So I like to use the channel. As I said, the channel is ideally supposed to give you a range from where the market started going up. And then it'll ideally, when we do this, we want to make sure that it's giving us the most accurate information. So, I'll zoom into it. I'll be very close to the chart. I'll try and this purple line should ideally be touching this top point. So this circle should actually be this top point, and then it should touch all the bottom points. So my channel should be right here. But for now, for the sake of simplicity and to save some time, I'm just showing you, what an analysis would look like. So this is a clear uptrend channel that we created, and we can see that anytime this price, sorry, go ahead.
So the time span I see is 2020 to 2022. So this is a two-year span on a daily basis.
Yes.
Right?
Yeah.
So you're looking at 2-year span to decide a short-term trade. What is the goal of this?
No, not a short term, a long-term trade. I'm trying to currently set up something for a long-term investing strategy and a long-term level where I should enter into the S&P for, let's say, 3 to 5 years. So that's my horizon. That's my goal.
Okay.
Yep. So when I do this, the next channel I want to look at is, which is following this one, is from the top here, going through the tops as much as possible into, let's say, here, and then this channel would be, and why I'm taking these over here, ideally this should be any point where the maximum tips are touching this line. Similarly, the top line, the maximum top tips should be touching the line. That's how we determine what should be the angle of the line. So when I'm drawing a line from here, I'm trying to touch 1, 2, 3, 4, so many over here, so many over here, all of these, and then these. So this line would essentially be touching the maximum points in that slope. Yeah. Now, once I draw this, all of these breakouts out of this channel are false breakouts, but I could also create a position here. So now we start looking at what should be, and I'll come to the indicators after this. But what does this tell me? This tells me that generally right now on a daily basis, the S&P should range or should trade between the channel. As soon as the S&P goes out of the channel, I will try to create a long position here once it breaks the upper channel. If it breaks the lower channel, I'll try to create a short position here. The basis being, as soon as this happens, the market is also looking at it. But when you are here and you'd want to look at tomorrow or the future, which will be here either up or down, you're not sure where the market would be. So you're trying to, follow the channel historically, extend it a little bit here. And then as soon as the price touches the channel stop, that becomes a support. Right now, it's a resistance. So for these technical terms, we'll share the fidelity document, but anything that acts as a top support line is a resistance, because you don't want the market to be going up all the way directly. So it hits the resistance, comes down, then again attempts to go and break the resistance, again comes down, again goes. Once it breaks the resistance, then it's supposed to enter the next side of the technical chart. So, the channel should not break, but ideally assuming now the market will hit the channel here, it will bounce back. So you extend the channel, it'll hit here, it'll bounce back. That's what's happening right now. Once this starts coming back into the channel, it's almost certain that now it should hit the bottom of the channel if the channel has been drawn correctly. So if my technical analysis is right, maybe someone else who's certified, of course, would have a much better chart than this, but then it starts to follow that particular trend. So it might take, again, based on the number of days, if you count all these lines, it's probably about 30 odd days or 40 odd days of trading, which is about 2 months. So this has happened probably in, the start of 23 is here. So maybe about February, 125. End of January. From end of January, so about 2 months of trading, right? 2 months of trading, it is still outside of this channel. So as of now, we do not expect this to come back into the channel. And I don't know if Nimish bhai, you remember, I shared this chart originally, at some point in one of the groups, where once this was broken, it has still not come back into the channel. And we are waiting that, if it hits, my trade would currently be using this same slope, extending it. And once the daily charts comes back to the channel, I'll do a long over here with a stop loss just below the channel. But if it continues to break it, I'll quickly go short. So I'll then move my position from long to short. However, coming back to the fundamental strategy, for me to now create a 3 to 5 year buy, it will be on top of this channel. So as soon as this market starts to retreat and comes, let's say, if I extend this. So if I extend this, now this is the market, but this is my original long-term channel because it covers almost 22 to end of 23. So this is a good determinant of how the market or the long-term trend is. And as soon as this hits, let's say in next 2 weeks or 3 weeks, if it hits the top of the channel, this is where I'll create my buy position. Right now, 37.37 or 37, whatever, It does not need to be accurate, to be honest. We're not doing day trading, but I'll create a buy position around 37.50, let's say. So 37.50 will be one of my good buys. The market might continue to go down and people can wait for it to hit, this level or whatever. But for me, this is a good enough buy. Why? Because every time it should hit a resistance, which will now act as a support. The market believes that now it should be a support for this particular level.
So
I
have a actually quick question. So after how many levels we should define, or we should be sure that maybe like this will act as a resistance?
No, it is already a resistance.
Sorry, it will act as a support. I meant.
No, it is now a support because the market is already above this particular.
So like, okay, it happened once, right? Like, but what if now it just breaks that support and goes down to the below one?
Yes,
so like,
exactly. So
maybe like it should bounce 2-3 times.
Yeah.
So I mean, is it likely that it should bounce 2-3 times and then that line counts as support, or it's like even single time it bounced?
Okay, no, that's a good question. So no, very valid question. You're right. The more it touches the line and bounces back, the stronger the support becomes.
Support. Okay, got it.
And similarly for the resistance. So 1, 2, 3. So it's touching right now.
Makes
3
sense.
times.
Got it.
So it's a good resistance. So that's why it's a good channel.
Similarly,
right. This one. So the more it will touch that particular line and come back, the stronger that resistance or that support becomes. All right. So for me right now, this might take 5 days. This might take, I don't know. I can't predict whether it might be down tomorrow. But for this level, I'm quite sure of. And whenever it hits near the level is where I want to create my first buy position. Then let's say it bounces back. I'm good. I bought at a good level. That's good enough for me as a long-term investor. I entered at the right level. I'm not looking at the exit, right? Let's say it continues to go down further. Let's say it hits middle of this. That's where my indicators now come into play. So now let me introduce the indicators. So this was just a basic understanding of what the trend of the market is, but the indicators would also give me a lot of other information. So I could use any of these, but as I said, people try to make their own, indicators and whatever they feel comfortable with, how they work with it. So moving average, convergence, divergence, some people try to look at accumulation, depending on some people try to follow Bollinger Bands, but all of these indicators don't work all the time. One, and we try to, when we try to form a strategy, we look at multiple indicators. The general rule of thumb is at least 3 to 5 indicators should give you the same indication. So they should tell you buy, they should tell you sell. Then it becomes a strong, trade. So if you're getting a buy signal on one, you're getting a sell signal on the other, it might not be the right, trade at that point in time. So I'll show you how that differs. The one that I like to use on the S&P are two of these. So one is a super trend. As soon as I put this, you saw the red and green line come here. The other is stochastic RSI. And you might have seen this came down, right? Now, what it tells me, I try to use these because I want to see the statistical model behind this indicator states, and I don't know the exact calculation or the formula or the definition of it, but as soon the most of the trading should happen between the pink shaded area. Okay, so that is 80 and 20. This should be 20, this should be 80. Now, whatever the statistical formula behind it, again, no disrespect to any of the indicators, but as a rule of thumb, what we do is if it's above 80, the blue line, can you see the blue line here? Or let's say this 100 and the 96, the red line, the blue line should now start moving downwards like anywhere else in the past. It will start moving downwards, but there will be a point when the blue line will cut the red line. That's when it makes or it says the downward trend is sure. Till the time it does not cut, which will not happen most of the times, like this point, it does not cut, it is not a sure shot downward trend. So that's what I'm looking for. It is again an indicator only. Once this cuts it, maybe it will cut it here, maybe it will cut it here, wherever. I will create a short position out of my position. If I'm trying to do a day trade, do a short term, let's say 3-week play, 2-week play, and all of this will be again based on my own capacity to hit a stop loss. And the stop loss, how we figure that out, how we set up a price target is something, again, a detailed study we can do and discuss. But that again would mean that, as soon as this indicator points me downwards, right now it's not, I will not do a buy position because it's on the top. It has to go down sometime. I will not do a short position because it's not cut it down. It's not telling me to do short. So right now it's like that. Similarly, once I change this from a daily to a weekly, you will see this will change. The blue and red lines might appear here trying to go up on a weekly if we do this. See, so right now it's just cut up the red one and the blue is going up on a weekly trend. However, now this is contradicting my super trend, the other indicator that I applied. The super trend is telling me right now that it's still in a bearish trend. So far as it's under the red line, it's a bearish trend. It should go down. Where it should go down from is it should hit the red line. Do you see this? Let me zoom it a little bit. Do you see this particular candle hitting the red line and then coming back again and then hitting the channel and then going up again? So ideally, it should follow this pattern, hit the channel, go back. It probably might hit the channel over here, maybe 2 weeks, maybe 1 week. I don't know, right? Let's say 2 weeks. It hits the channel at 2 weeks. The level for the channel at 2 weeks is 4190 or 4200, 4206 right now, or whatever. But the more we zoom into it, the clearer the picture will get. So if I zoom it, now I see 4215. Yeah. And that's what the CMTs or the day traders, they would have people working on the charts all the time and looking at this and giving them the live information. They'll keep on during the day telling them, hey, the level has changed. This is the new level. This is the new level. And the levels just tell you, okay, the trader might decide, whosoever is trading, when it hits 4215, should I enter a trade at 4200? Because all the zeros, fives, or 5 zeros are generally psychological levels. People don't see 94.5 as a level. People see 4200 as a level, right? And all of this again is the psychology of that day-to-day trading. But for all long-term purposes, we don't need to follow, let's say, every dollar, every price movement. I could just say, yeah, I can create a short position here, assuming they should hit the level and go back. I'm not worried about 15, 20, 40, points movement. So that's how you will design your trading strategy. For me, it's very simple. I just apply these. I look at a weekly trend going up. So I'm assuming that, yes, it will continue to go up and hit this level and then come down. I might, for a very short term, maybe when I'm looking at a weekly, I will look at a 3-month period. So for a 3-month period, I might create a short position in the market. I might sell some futures or through options to mitigate my losses. But I'll take that position with that stop loss in mind and try to play the movement from here back to the channel. That's it. That's my goal. So I'm trying to, play that short-term strategy of moving it back. But as soon as it comes near here, if I'm making a profit on this, all that profit helps me to buy back for the long term for my long-term strategy over here. So this is a good buy and I let it go. If it goes down further, all I need to do is I need to arrange more money to buy it during this entire channel move. So I'll keep on doing either a good DCA amount or I'll save all my DCA amount so far as it moves. And 3 months later, I might invest here. It might not hit here. It might just bounce back from here. But that's a call that we'll have to make based on those charts and as this evolves. So this is, just one study and one type of chart analysis that we'll do and we'll look at and try to follow this to create certain levels. And these levels will help us then determine what might be a good level to buy, what might be a good, point to enter at, all of that. So I'm sorry, I did not know the timing on this, Nimish Bhai, but I was moving on. I realized now we passed the hour.
No,
Any other
if you have
questions?
if you have something more, you can add, or we can do a discussion. People will have.
Yeah, going back to our slides, I think
That's it. Yeah.
that's it. Yeah. So any other questions? Happy to address and happy to discuss strategies. Individuals might have their own viewpoint. What I try to do is look at it maybe every third day, I would say, and see how the market has changed. These channels that I've shared might be in one of our groups. I don't know, Nimish Bhai, if it's in the TMC group or maybe the other one, but I know I shared this view because I've been following this view since the start of 23 for sure. So this is where I started with this view around, very, very close to the start of 23. And it was about to break this. I mentioned on the group that if it breaks, it might bounce back. It did bounce back very short temporarily, but then it broke. And since then, it has not come back, as you can see. So the channel is holding true to itself. I'm hoping that this continues. And so far as it continues and we are in the super trend of being bearish, I would try to play this white gap. And once it enters and breaks and enters back, then my strategy would change accordingly. Because then I'll move to a bearish position much more and strongly. I'll continue to be bearish till the end of the channel and then go long again from there. And this is all outside of my personal portfolio. So let me tell you, I do not touch my retirement funds. I do not touch my long-term investments when I'm doing this. I keep a 20% portfolio just to play around, just to see, test my strategy. My targets are not there to make profit out of this. I don't run my house based on my trading income. So for me, it's very simple. Just to be in touch with the market, play with the 10, 20K I have. I keep on doing that as a leverage play. So if I'm managing 20K on this, I'm playing around with around $200,000. So, that's how I manage this, which is not advisable at all. That's my
So,
the shady side of me.
this example looks at the price data.
Yeah.
Now, those day traders that are, your window is over several years. How will those day traders do? They're
So
constantly.
if I were to look at this as a day trader, right? I will first of all go to a 1 hour chart. The first thing I'm going to do is look at just this. And my first 1 hour chart currently tells me that the price is overvalued. Right now, the market is in a strong bullish trend. It's currently hitting here. There might be a small retrace tomorrow. The retracement might come to say about 1 to 2% of the market, 1 to 2% of the market. That is a good buy point because the market is still in the bullish trend. So as soon as it hits, what would be 1% from here? So 4,100, 88 points. As soon as it hits close to 40, 30, 40, 3040, that's where I'll enter a buy trade and follow the trend. I will not try to short here. So if I were a day trader, Monday morning, I'm not looking at a short, not at all. Then I'll go to
sorry to interrupt, but so basically, like, is this stochastic RSI is it like similar to the normal RSI indicator? Like, basically, I mean, as far as I know,
yes. So it's
above 70 is above 70 is like overbought, and below 30 is like oversold.
That's
so right
right.
now
So
it's
it
in overbought.
follows RSI, but it's a bit more advanced than the RSI.
So right now it's not like, basically this does not state like it's in overbought category, right?
It does.
It is. Okay, it does. Okay.
It's over here. If you can see this.
Yeah, it's 95 or something, right? Around
99 and 95. Yeah. So it should ideally revert back. But again, this acts as a channel. So as soon as this comes back, sometimes it should bounce from here again. If if the bullish trend remains, that's why I try to apply two trends together, two indicators. If the bullish trend remains, if it does not break through this green trend, that is the time it will not turn red. So if it does not break here and it's over here, let's say the blue and the red hit this part, there is a strong indication that they will bounce back again. So they will go up again.
Makes sense.
So we try to, look at these indicators and devise a strategy. So I'll, Nimish, to answer your question, I will look at the 1 hour, I will look at the 30-minute, I will look at a 15-minute, and let's say we are now at Monday morning. As soon as I changed it to 15-minute, you can see it's a strong bullish trend. It's anyways in the super trend. It is still going up. It should ideally touch either here or here. That's where this should start reversing from. So I will not create a short position in any case. Even if there is a pullback, let's say 4110, the market comes to overnight. So which is if it opens 6 p.m. today and by tomorrow morning pre-market, if the market is trading close to 407075, I will definitely buy over there, assuming that this trend should continue. And that's my short-term day strategy. So if I were to play, I will not with a very strict stop loss, of course. 4050 will be my stop loss. If it continues like this, 4075 tomorrow morning, if I see it at 7 a.m. or 8 a.m., I will buy over there and I will try to make like 30 to 40 points profit during the day. That's it. So which is again back to 4110.
Okay. So, but the accuracy of your decision relies on the accuracy of how good you draw the channels.
Exactly. Or this particular right now, I'm not looking at a channel. I am outside the channel right now. So right now my channels are not there. If you see right now, I'm just following this indicator and this indicator, the green line and this stochastic RSI.
And how percentage wise, how accurate it is?
The accuracy should be considered as 0. Your stop loss should determine your accuracy of the trade. So the accuracy, let's say, call it 0 because you don't want to rely on this completely. Any technical analyst could say, oh, it started to turn over here. That's an indication that now it should start going down again. If it's going straight up, there is no indication that it will not go down again.
And you see that in if you go 1 inch on the left in the bottom chart.
Yeah.
You see that.
This one, right?
Yeah,
This
go
one.
left, a little bit, 1 inch, one more, one more, 3 more.
Okay.
See that peak?
This peak.
All right. So it came down.
Yeah, exactly. So, it's something that you cannot rely on completely. It is giving you an indication, and that's why they are called indicators. But that indication says right now it's in a bullish trend. It is going up. It should touch either here or from here, from where it should reverse. Assuming that this continues, if it gives me any pullback, my strategy will be to buy at that pullback. As soon as this gives me any bounce back from 4110, if it gives me 4080, 4075, I will create a buy position with a stop loss at 405. Simple. So I'm ready to lose 25 points for a gain of 40 to 50 points. That's my strategy.
Okay.
Yeah.
And so that's a typical day trading where this could be a 1 day thing.
Yes.
Right?
I would not advise that again, but and it takes a lot of mind space. You have to be very active. You can't do this passively.
Right. Yeah.
I mean,
And
unless
it's
some
not
people
successful
are
all the time.
already retired, then it's definitely not advisable. But if it's someone has time, I would not suggest doing this. It'll take a lot of mind space, and all my hair are gray already. So
I would add one thing that, attending this session, like, I feel now like my job is much easier than this. So,
no, definitely. I mean, no doubts about it. Where is my Zoom? Why can't I? Oh, I don't know.
Okay,
where's my Zoom.
so one more thing is, so this is based on the price change. You also have similar analysis or indicators for the volume, decisions based on the volume.
Yes. So volume, unfortunately, we cannot see over here for this particular investing. We do have the volume indicator, but they don't publish the volume on a daily basis for S&P, maybe for some other product. And then there are things that you can change with this as well. This is currently showing me volume for the day, but it does not populate. I don't know why, but yeah, in most of the softwares you will get volume for sure, and volume is a large indicator again, because if this particular, let's say, let me zoom. Let's say I'm looking at a daily
Okay,
candle.
so let's
Yeah.
Another question from my side is, so you're looking at the index, thinking you're buying the index funds.
Yeah.
But most of these guys are looking at the stock.
Yeah.
Right.
Let's take it to a stock.
Could be someone looking at Apple stock, for example, right? When to buy and how long to hold and that kind of stuff. Or say Tesla.
Okay.
Right.
Tesla is a very bad product for technical indicators. To be honest, that's played only by technical people. So I would look at Apple.
Apple, yeah. Tesla is very volatile. Yeah.
Yes, Tesla is not. Where is Apple?
AAPL.
Oh, why did I put T? I thought I put AAPL.
Okay. So one thing
So over here you'll see the volume. The S&P does not show the volume, but over here you'll see the volume.
Right. So one thing I can say is you're too much zoomed into, I mean, you in the sense, technical analysis is too much zoomed into price and volume.
Yeah.
Whereas outside, Mr. Tim Cook may be meeting or setting up a new plant in China.
Yeah.
And that will spike the whole thing. Forget the lines. We know exactly that on Wednesday, he's going to announce a new plant, and that's going to bump up the stock. So it's a combination of analysis, and I'm not a day trading guy. I don't support. I don't recommend, especially new guys. This will be an experiment. This is like going to Las Vegas and having $100 and playing across 20 machines, the penny machines or quarter machines, and losing everything at a time. So,
Yeah.
you know, they have simulators, investment simulators, fake money. And I think Investopedia used to have it. I'm not sure if they still have it. If you want to practice, just to learn, not to exercise in your real life, but just to like a video game type thing, that kind of joy, then played in the simulator. I'm quite sure people have learned this and or mastered this analysis by losing a lot of money also.
Yeah.
Lessons learned, right? So very risky.
One thing, and as I said, there's lots of books on this, and which I think could be a good place to start. But if still anyone is interested, I observed one thing. I don't look at normal stocks generally, as I mentioned, but I look that within the Apple stock. Let me just cancel the super trend for a second. Do you see a lot of gaps? Do you see these gaps?
Yeah.
Do you see these gaps everywhere, all throughout the stock? This is a very good, and you'll see it in the Fidelity file. Let me show you. In fact, it should have. Do you see this? Gaps. There is a whole slide on this. Do you see this?
Supply demand changes.
Yeah. So, and we've shared this file. You can go through this. But when I was looking at this, I observed, so a lot of these gaps. I'll tell you one thing that I learned about gaps, and it could be right, it could be wrong, I don't know. But whenever there is a gap in a candle chart, in a candlestick chart, it will never be there in a line chart. As I said, line charts move from the top to the top. So line will be drawn like this instead of showing us the gaps. That's why I try to follow the candle charts. The gap has a theory. The theory is, if a market created a gap, whether it's an upside gap or a downside gap, the market has a tendency to remember history. And when we say history, means all the price movements by ticks, as I was saying, tick level price data, it remembers every price movement. If there is a price gap in any kind of chart, the tendency of market remembering the history will bring it back to fill that gap. What that means is, if there was a gap that was hit over here, whatever continues to happen after this gap, the market will definitely come down and fill this gap. And you will see there will be a lot of trading happening during this gap. So if I were to zoom over here.
So gap gets filled out at a later future.
Yes, at a future time, it will have the tendency to fill out that gap. There's my rectangle. So you can draw a rectangle here and see, sorry. And you will see that, that gap in the future will have a lot of volume trading. It will come down and fill that gap. As soon as this gap occurs, it will be part of either a previous gap or it will be filled out in the future. So if this gap did not get filled out, that means it is driven from this particular trading.
Okay.
And it will be applicable to all the gaps. If this was a gap going down, these gaps got created, the market went up, there will be a lot of trading in this area, in this region.
So,
and the logic behind that we were given or taught is, let's assume it's a big liquid product, just like Apple. There are 300 or 3,000 firms trading Apple in a given day. All the firms either have a buy or a sell position, and the market opened in a gap. That gap would hit either stop losses or would hit target profits of certain firms out of the 3,000. And certain will be left hanging because it depends on the type of order that you put in. Sometimes you just have an open position, you do not have a stop loss, you do not have a target profit, and the market moved with a gap, your position is left exposed. And that is when all of this, theory came into play, that the market will come back to fill that position, fill that gap. So if I was overexposed and I have a trade, the market knows open interest. They calculate something as open interest at the end of the day. My open interest or my position, my long position will show as open interest for till the time it does not come back to fill that position for me.
okay.
Yeah, and it works both ways, up and down.
Now, where do you see in investing.com the orders put in and all that.
No,
Live.
that is, I think, information provided only by high-end brokers. So it will not be available in any free platform. At least
I
I
think
haven't
Webull
seen.
has it. No.
Webull has it.
Yeah, Webull, and I think Webull has it for sure. It has all these chats and like also the volume and filled and all of that. I think Robinhood started recently as well, if I'm not wrong.
Hmm.
Yeah.
Like it's
Yeah.
pretty recent.
Okay.
Yeah.
All right.
But like for like normal, like when we do dollar cost averaging, right? Like, yeah, I mean, if we follow this strategy, or like maybe instead of doing like investing every 15-30 days, I mean, I have been doing mostly that till now. So I was just thinking like if we follow this and then just try, instead of doing that, maybe just try to put that amount, whichever we think, like maybe say like $500 a month, right? Just as an example, then instead of putting 500 every month, just let it accumulate, and then once we maybe decide on this, and when we feel like okay, it says bottomed out, I mean it we can put that, right? Like, so it might be much more profitable, I think. Or
No, I will
So
tell
it's a
you.
risky, it's a risky strategy again. So
risky
if,
thing.
if I were to design your strategy for this, let's say you want to put aside $500 a month, and taking this example, 500 is your entire corpus or your entire amount that you can invest. I would break down that into two buckets. One should be a 50% of 500 or X amount, whatever that is.
Okay.
So 250, you should invest at a regular interval, irrespective of the price.
Okay, got it.
The other 250 should ideally be a factor of the volatility of that product where you're trying to invest. So if you're doing a DCA in the S&P, in an index fund, if you see historical movement of the S&P as a product or as a index, it does not, or it rarely has days where it has moved 3% in a day. You can do that analysis from any historical data of the SPY. Now,
Right.
if 3% is a big number in daily moves, any day that the S&P breaks 1.5% or drops 1.5%, you should buy 10 or 20% of that remaining 250. So if that can be factored like that, if the amount, now we have factor trading, so we can actually do it. But if the amount is like this, that you can't really factor it into those smaller intervals or smaller amounts, you should try and do it through a derivative product. So a derivative product would mean buy an ETF, which you can buy at any value. You can identify some other correlated product which can give you the same exposure. So ideally, since all of these are long-term strategies, you want to do your research one time very strongly and then follow a principal approach. If you try and change your principal approach or do a new research, you'll end up digging too many wells, but
Yeah,
your water
that's true.
requirement will still be the same. You'll not be able to drink more, right?
Yeah, no, definitely. Agreed on that. Thank you.
I will, my opinion is this, the 50-50 that you said, I'm okay with that. So let's say 500 a month. So 250 is invested every first of a month, and the remaining 250 is through derivative or through, I would put a limit order or something.
Yeah.
Because I'll tell you, you will get tired monitoring every hour for that 50, that in the 6th month, you will give up.
Yeah.
So, and this is a very tiring, emotional decision making.
Yeah.
And I've done vaccine stocks. I made a lot of money. I used to be awake till 3 o'clock in the morning, reading this, that, and then every minute buy, sell, buy, sell. It was tiring.
Yeah.
And it will not always work. That's another thing. Even if you put so much hard work, it's so emotional. So yeah, I would do, I mean, middle path is 50% on a fixed time, and then the remaining 50%. Create a limit, 3% drop, buy it.
Yeah. Exactly. And
one
irrespective of the
guy,
price again. So,
yeah,
if you are anticipating the S&P to move to 3,400 or 3,500, as an example, we were just looking at that chart, you have to be reasonable. You can't say it will come to 3,500 in the next 2 months.
Right, definitely. That's
Looking at if it historically hasn't hit 3%, from here to hit
yeah,
3,500, you are expecting continuous 3% down days.
Yeah.
definitely.
And which hasn't been the case. So, and there are, again, knowing your product really helps, or doing your diligence, because look at this way. All of us, most of the people out of the 300 million, the working population in the US is close to about 20% or 25%, which invests through a 401k. So let's assume 60 to 75 million people are doing a 401k. Most of the 401ks are driven by the employers. So everyone who is getting paid through the employer and investing in a 401k means, by default, a portion of their paycheck is given to a Fidelity or a Vanguard or a Transamerica at every Friday. Do you agree that? So if money is flowing into a Vanguard or Fidelity or some other investment firm every Friday to be invested in a particular set of bunch of stocks, it has to be invested. So money, that means, would continue to buy it irrespective of wherever it is. So the long position is definitely there. There is no stock or no 401k in the US which invests as a short-term strategy, as a or they would short an index. They are always long, right?
Yeah.
Right.
So every Friday, someone or the other is buying it, whether the index is at 4,800 or whether it is at 2,800.
Yeah.
So you're getting DCA. Basically, it's every Friday's DCA.
Every Friday. It could be Monday, it could be Friday, it could be, I don't know. But you can imagine the continuity of the entire arrangement. If 75 million people are contributing to 401k at the scale of maxing it out, 22,500 or 23,000, whatever, divided by 12, and imagine that amount coming into the market every day.
Yeah, I would, if you look at the price level at this level, this chart, using technical analysis, to me, it's me. The real value is on a highly volatile stock, you'll gain a lot. Index is volatility will not be as much as Tesla, for example.
Yeah,
But then
exactly.
it's risky. It can go the other way too.
Yeah.
So, because the delta of peak and the bottom in a day will be much higher in a highly volatile stock.
Exactly. And that's where PM comes in. So if you get, or you're managing or trying to trade a very volatile market or a stock or whatever asset, you need to be better at portfolio management than at trading. And I'll tell you why. The reason is, if you, let's say, have a $10 million portfolio, you get exposure at 10% of that. If you're trading a Tesla, your daily move can easily be 10% right now, right? 5 to 8% is normal.
Yeah.
So if you're looking at a $1 million portfolio, $1 million exposure every day, to burn out your portfolio, if you do 10 wrong trades, you're out. Right? Yep. It's as simple as that. So your risk management and your portfolio management is very, very key over there. You need to understand what product you are trading, how volatile it is. And I can give you an example from my experience. I used to trade gold and silver, as I mentioned. Gold is still a very, very tamed product. Silver can be as wild as Tesla, maybe more. So silver, on the other hand, is highly volatile. There have been days when gold has moved 1%, silver would be 3%. So I would always fear entering. So I used to enter two legs. One would be gold, one would be silver, one would be long, the other one would be short. And I used to enter silver first before entering gold, because I knew if gold moves, I will not be able to catch silver. So that's an understanding of the products that you are trading. If you feel that one product is more volatile, you need to change your strategy accordingly. If you are trading an Apple and trading a Tesla, you need to be two different people, ideally.
Yeah.
Yeah.
You have to decide that 20% the risk based.
Exactly. And all of that goes into your homework before the actual trading time.
Yeah. So there is one like DCA, there is a value averaging. You guys can research that. That is picking up. And so it's similar to DCA, but it's a new concept. Value averaging. You guys can research. Investopedia has a good article. So no, this is good. This is something different. I've always I'm scared of this short-term day trading. I used to day trade. They used to have the simulator because
Right.
the thing is,
But I still honestly don't understand the Indian day trading one. Like I mean, at least we used to. I mean, I used to hear from my father at least that, like basically they gamble it in the morning and then in the afternoon, whatever price it is, they sell it. So I just don't understand how. I mean, people do that because why would one sell it if it's like basically running at a lower price, right? Or like, is it
They
like
they
something that
have
they
to
are
book
forced to?
that. That's part of your discipline. You have to book your position at the end of the day. And also in the Indian markets, it's very different.
No,
The
no, but
difference, yeah.
why would someone do that? Or like they are forced to, or like they just kind of like, I mean, I just don't.
because they are selling so that they can use that money for next day's trade.
Exactly, exactly. So there could be multiple reasons. The force part is a lot of brokers would give you leverage to play around with money only during the day. You cannot carry over your position. If
I
you
see.
carry over your position, you have to submit 10 to
Yeah.
5 or whatever percent
And
margin.
then their matrix, success matrix or performance matrix is out of total 20 trades, day trades in a month. They need a success of only 12, 15.
Yeah,
Yeah,
definitely.
yeah.
And
And
there were no tools. There are no tools a few years back
yeah,
in India. So it was all. Imagine how they were trading with
yeah,
the stock prices coming in newspaper.
Yeah,
Remember?
yeah. Yeah, my father was used to tell me like after we were watching Harshad Mehta and like
Yeah.
seeing all those like earlier they were like he was telling me the same thing like when he started trading he was like right now it's so technology has made it so far like earlier it was like nothing.
Yeah. And then nowadays the AI tools. So what Jitin explained, where human beings are involved, AI is doing all these decisions. So it's getting scary.
so
So
that part is called that's what we started to do. It's called HFT, high frequency trading, and
mm,
it's generally done through algorithms. And that
I,
algorithmic
there are
trading,
also couple of applications like Wealthfront. I think it is one of them, or like where AI automatically manages your portfolio. You just need to
robo
define
investors,
whether
yeah.
it's whether you are like high risk, medium risk, or low risk, and it usually keeps on buying for you and keeps on selling for you. Um, uh,
so you guys are more technical, but I can tell you in my trading days, I used to work with coders who used to do this for us. And what we used to tell them was what the algo or the software will do. And that strategy is then coded by the person into the software, and then the software is back tested to see if that strategy is actually working with simulated data in the real market or not. And then once you are sure that yes, your risk and reward ratio is fine, it is giving you the right returns, it's not taking too much of a loss in a particular day, then you deploy it in the live market. So what we used to do is, and I think part of it is still being done, all of these formulas keep on changing, but the algorithms are essentially APIs that run on top of the trading software, the ladder that I mentioned. So that combines the ladder with the exchange feed. So the exchange feed is sending you the prices, the real time prices. Our software has a code which will detect that price that is coming in, calculate the formula that we have told the code. For example, it could say every 5 minutes, if my moving average is moving by 10%, it should create this position. So if my moving average was 18 and 10 minutes later that became 16, which is a variation of more than 10%, it should be 16.2 because it's doing all that calculation at a very high speed and the computer knows all those numbers much faster than a human brain. It will create a short position. And that has to be coded. So you tell the code, what it will do in different scenarios, and then the code keeps on doing it 1,000 times during the day. You can't do it manually.
Wow.
Right.
Yeah. So that's how it trades. Then different hedge funds across the world have different black box. Some call it gray box strategies, but these are all just very simple, trading formulas that you get coded into like I can tell you, one of my friends who is still a PM, he is working out of Dubai. He has a fund and that got listed on SEBI about 2 years ago. But his fund has a very simple formula. Do you guys know Nifty, right? And then there is an XGS Nifty. His formula is just trading, his algorithm just trades these two, XGX Nifty and Nifty. He buys one, sells one. So he just plays on that delta the whole day long. Nothing else. Can you imagine a simpler strategy? Every day for about 20,000 trades, his formula, his algo is doing buying Nifty, selling SGX, or buying SGX, selling Nifty. And he's just playing that delta for a very small spread. So he's making the market, he's providing liquidity to the market. His margin requirements are probably about $3 to $4 million. I don't know exactly, but his margin that has been put into both the exchanges is mostly about $3 to $4 million. And he's doing 20,000 trades in a day, making about, I think, 2 or 3 rupees a trade. Rupees. I'm not even talking about dollars. So he's making 2 to 3 rupees a trade. The only idea is that his costs with the exchanges are so low. As a retail investor, our cost to trade one trade is 20 rupees. How can we make a profit with 2 rupees? But their costs are literally in paisa. So if they are doing 20,000 trades, they are also providing that liquidity to the exchanges, right?
I mean, I also feel like apart from like doing so many things, I mean, the safest one, if you want to do something like this, I mean, I feel like one of the strategies which I know is like basically doing call sell in S&P 500. Like if you have like 100 more shares, right, and you do a call sell, it's the safest most, because I mean you will at least lock your
The
profit at
premium, make the premium, right? The
the
idea is to sell a cost, you have
you
to
will
have more
have the
margin than
collateral.
buying.
Yeah, you will have to have the collateral though. So I mean, if you just keep on buying and then I mean once you have that much amount of shares accumulated, I think that's the best way to just kind of like make few money, which is like most safe as well. Like at least you will not lose money on it.
No. You're wrong, my friend. So you are overexposed. When you are taking a profit, the maximum you can get is the premium by selling the call. But
Right, but
you
I
are
think the
overexposed on the other side.
right, the
If
profit
market
is
goes against you, it is infinite loss.
no, the profit is capped, right? In that, I
The
haven't
profit
done
is capped, the loss is not. Exactly my point. So you are overexposed. If the market
yeah,
goes against you,
but S&P would never go to like 100 or like you like it won't fall by 50% any day, right? Like that's what I'm until unless something like really drastic happens,
I mean,
right?
I do call and put all the time, but I would not sell a call at $6, assuming that it can be 25 the next day.
Right, yeah.
So
Okay. So let's conclude this. So, because then I can stop the recording. So this short-term trading or technical analysis is mostly focused on short-term trading, especially with the price movement and volume data. You need to have a lot of time on your hands. For the new guys, it will become an experiment and you will learn the hard way. So it is not for faint-hearted people. And if you still want to play, don't use your 100% money.
Yeah.
It will become a Las Vegas.
Yeah.
So this is something similar to crypto. Invest the money that you can afford to lose.
Yeah.
But from the learning perspective, Jatin Bhai gave a very good presentation. It's a good start.
Mhm.
That Fidelity document, the link that he has shared, will share in the group.
Yeah.
But
We can also download the document and put it on the drive.
Yeah. And we're not trying to inspire people to do this. This needs a lot of experience and all that. And honestly, if you're making at least 9% on a long-term fundamental analysis based investing, no need to experiment new ways just because you are greedy.
Yeah.
I always tell people, if you make 9% over 10 years average, you're doing good. So, but of course, everyone wants more than 9%. So, all right, Jatin, but you want to add your suggestions,
No,
conclusion?
I think do it if you want to and really want to try. The first thing is to do your homework, try and understand, do the paper trades for 30 days, understand what you're trying to get into. Once you have that knowledge, get into it with a very small percentage of your portfolio that you can afford to lose, to be honest, because losing here takes much lesser time than gaining. So, you'll end up, you get into different psychologies. You lose some, you win some, you get into a psychology where, oh, I can recover it. And that might just spiral into something bigger. So instead of snowballing it, my advice would be that make sure you're knowing what you're doing and playing with the money that you can afford to burn.